Financial instruments are the building blocks of the global financial system. They are the contracts or documents that represent ownership, a debt obligation, or the right to buy or sell an asset. In essence, financial instruments are the tools that allow individuals, companies, and governments to raise capital, invest, transfer risk, and manage their financial resources effectively. From the stocks traded on Wall Street to the bonds that fund infrastructure projects, and the complex derivatives used to hedge against currency fluctuations, financial instruments are everywhere, silently powering the wheels of the economy. To understand financial instruments, it's important to grasp their fundamental purpose. At their core, these instruments facilitate the movement of money between savers and borrowers, investors and issuers. They can be simple, like a straightforward loan between two parties, or highly complex, involving multiple counterparties and contingent claims. But regardless of their complexity, all financial instruments can be classified into broad categories based on their characteristics and the roles they play within the financial markets. Let's begin with equity instruments. These are claims on the ownership of a company. The most familiar form of equity instrument is common stock. When you buy a share of stock, you're purchasing a small piece of that company, giving you the right to a portion of its profits and, typically, voting rights in corporate decisions. Preferred stock is another type of equity instrument. While it generally doesn't come with voting rights, it offers investors priority over common shareholders when it comes to dividends and claims on assets if the company is liquidated. Equity instruments are vital for companies seeking to raise long-term capital without incurring debt, and they give investors a chance to participate in the potential upside of a business. Next, we have debt instruments. These are contracts where one party lends money to another in exchange for regular interest payments and the eventual return of the principal. Bonds are the most well-known debt instruments. When you buy a bond, you're essentially loaning money to a corporation, municipality, or government, which promises to pay you back with interest after a set period. Debentures are similar to bonds but are typically unsecured, meaning they're not backed by collateral. Notes are another form of debt, often shorter term in nature. Debt instruments are attractive to investors seeking predictable income and lower risk than equities, though they still carry the risk of default. Derivatives represent a more complex class of financial instruments. Unlike stocks or bonds, derivatives derive their value from an underlying asset, index, or rate. Options, for example, give the holder the right, but not the obligation, to buy or sell an asset at a predetermined price within a certain time frame. Futures contracts obligate the buyer and seller to transact an asset at a predetermined price on a future date. Swaps, another popular derivative, involve exchanging one set of cash flows for another, often to hedge against interest rate or currency risk. Derivatives are used for hedging, speculation, and arbitrage. While they can offer powerful risk management tools, they also carry significant risk if not used carefully. Money market instruments are short-term financial instruments with high liquidity and low risk. Treasury bills, or T-bills, are issued by governments and mature in a year or less, making them a favorite for conservative investors seeking safety. Certificates of deposit, or CDs, are time deposits offered by banks with fixed interest rates and maturity dates. Commercial paper is an unsecured, short-term debt instrument issued by corporations to finance their day-to-day operations. The money market is essential for managing short-term cash needs and ensuring liquidity within the financial system. Foreign exchange instruments are tools used to facilitate currency trading and manage the risks associated with fluctuating exchange rates. The foreign exchange, or Forex, market is the largest financial market in the world, where trillions of dollars are exchanged daily. Instruments such as spot contracts, forwards, options, and swaps allow participants to buy and sell currencies, hedge against adverse price movements, or speculate on future currency trends. These instruments are vital for global trade, investment, and monetary policy. Commodity instruments enable participants to invest in or hedge against changes in the prices of physical goods like oil, gold, or agricultural products. Exchange-traded funds, or ETFs, Track the performance of a particular commodity or basket of commodities, giving investors exposure without having to physically own the underlying assets. Commodity derivatives, such as futures and options, allow producers and consumers to lock in prices and manage risk. These instruments help stabilize markets, provide price discovery, and create investment opportunities in sectors that are crucial to the global economy. Hybrid instruments combine features of both debt and equity or other financial instruments. Convertible bonds, for example, are debt instruments that can be converted into a predetermined number of the issuer's equity shares. This gives investors the potential for upside if the company performs well, while still offering the safety of fixed interest payments. Other hybrid instruments include preference shares with embedded options or structured products tailored to specific investment objectives. Hybrids offer flexibility to both issuers and investors, bridging the gap between traditional asset classes. How do investors and institutions use these tools? Financial instruments serve multiple purposes. Investors use them to diversify portfolios, generate income, grow wealth, and manage risk. Institutions, such as banks, insurance companies, and mutual funds, use financial instruments to allocate capital efficiently, hedge exposures, and create products that meet the needs of their clients. Governments use them to fund public projects and manage economic policy. Each instrument comes with its own risk and return profile, liquidity considerations, and regulatory requirements. Risk is an inherent part of investing in financial instruments. Some, like government bonds, are considered relatively low risk, while others, such as derivatives, can be highly speculative. Return expectations must be balanced with risk tolerance. Liquidity, the ease with which an instrument can be bought or sold without affecting its price, is another key consideration. Regulatory frameworks exist to ensure transparency, protect investors, and maintain the integrity of financial markets. Understanding financial instruments is essential for anyone involved in finance, investing, or business. Whether you're preparing for professional exams, managing your own investments, or simply curious about how the financial world operates, a solid grasp of these tools will help you make informed decisions. By learning the differences between cash instruments, like stocks and bonds, and derivative financial instruments, such as options and futures, you gain the knowledge to navigate the market's complexities and seize opportunities with confidence. Financial instruments are the language of modern finance, versatile, powerful, and indispensable. They connect people, companies, and countries, enabling progress and prosperity in an interconnected world. As you continue your journey in finance, remember that each instrument has a role to play, and understanding them is the first step toward financial success.